Hey, everybody. Hopefully you're killing it out there. Hopefully your portfolios are doing well for you. And if they're not, maybe I can turn it around for you. Click subscribe, give me a thumbs up. I named this presentation, it's just, I want to make money. How do I do it? How do I make millions of dollars? Well, I can tell you how you make millions of dollars. This is how you make money. All right. This one's, I want to make money. That's all it is. I want to make money. So how do I make money? How do you do it? So first you develop a strategy. It's a vision. And when you have a vision, your entire paradigm, your entire investment life, so to speak, starts to look and mold around this vision. So you're going to start seeing things from this vision standpoint. If you're looking for cows, you're going to start seeing cows everywhere. If you're looking for McDonald's signs, you start seeing McDonald's sign everywhere. Whatever your vision is, and you start putting attention to, is what you start focusing on. So the strategy is very important because that sets the vision. It sets the pace. It sets what you are focused on and what you are paying attention to. You need to find the value in the market. If you don't have value, you're screwed. So you're looking for extreme valuations to the downside. You want to look for valuations that are anomalies in history because that's where the opportunities are. You're not going to take an extreme valuation to the upside and ride it a little bit more. You need to take an extreme valuation to the downside and ride it to an extreme valuation on the upside to really maximize your returns. And the way that we do this on this channel is we use ratios. And all that is an asset priced against another asset, and then you compare it to history or time. And whenever you see a ratio that's extremely cheap in relationship to history, you need to do further digging into that sector. Now, you can find extreme valuations to the downside, but it doesn't mean that it's going to turn around anytime soon. That's a problem that some people get into is they say, hey, look, this sector is valued absolutely great, but what if it's still another 5 years or 10 years away from being an investable sector because the market conditions are not ripe enough for that sector to start moving up? So what else? Another thing you have to tie in here is you got to look at market conditions to see if those valuations are ripe for change. You want to look at the market conditions and say, yes, we have changing market conditions. And when you have changing market conditions, what that spurs is a rotation of money from one sector to other sectors. And that rotation of money is extremely important because the rotation of money goes from overvalued sectors, that's where all the money's piled into, to the undervalued sectors based off of certain market conditions, based off of the collective thought of investors. You can see that in the charts. You can see it if you know what the drivers are. And what the drivers are real estate and interest rates. When real estate goes up and we go into an expansionary phase, it increases inflation. That inflation creates real negative rates, which then forces people who own bonds to sell. That's the rotation of money. When people sell bonds, it increases interest rates. And when interest rates increase, that also in turn forces people in the stock market to rotate out. So you have bonds being sold and stocks being sold, typically at the same time, going after inflation hedges. That's where our commodities come in, where we're sitting in the commodity sector with our entire, we'll call it coalition of cheetahs behind us going, let's get this thing rocking, guys. So we find the sectors. We know what's cheap. We look in the market, we do our ratio analysis. We say, crap, uranium's never been this cheap. I've never seen a sector this cheap in my life. Oil's cheap. They threw copper and nickel in the garbage, and we're going to pick that out of the garbage and use it because it's so cheap. Find the sectors that are the best value. Those are all great values. Platinum's in the garbage too. They threw that in the garbage, and somehow rhodium and palladium are the metals to have. I think platinum is the one to have. So we deploy money into those sectors using an allocation strategy to ensure we captured the gains of that sector. Dollar cost average in and out of positions. That's what I use. We know the exit strategy is tied to changing market conditions, which spurs rotation of money out of the sectors that we own. So our exit strategy is when we see the market conditions changing against us. Right now, they're changing for us in the commodities sector because commodities are cheap and the real estate housing market is going to rotate that money into the commodity sectors. It's an expansionary phase of real estate is what it's called. So the hardest part, this is going to be tough. You need to know the valuations and market conditions inside and out. There is no ifs, no ands, no buts. You have to know that inside and out. The valuations are the most important thing because it tells you when to buy and sell. And I'm going to be completely honest here. It is being able to hold on is another important part, and it is very difficult to do, especially if you don't know what you're doing. You need to be able to hold on to an investment that goes up 100 times or even 1,000 times if you want returns that large. You're going to have to be able to hold on. I can talk about 50x or 10x or 100x times your returns, but if you can't hold on to them, you're not going to get them. You'll never realize something if you can't hold on. So you have to know the valuations inside and out. Research the hell out of companies and find those higher risk good assets that are smashed to bankruptcy companies. And when I mean they don't necessarily go bankrupt, but everyone's smashing it down, short selling the hell out of it, like they're going to go bankrupt. And if the commodity price turns around on them, they don't go bankrupt, and then they become rocket ships. Debt is a good thing in a highly inflationary environment and when commodity prices are going far higher. So I wouldn't be debt averse. If a company has some debt, I wouldn't write them off. I would actually be drawn to them. Now, I'm not saying that you go find the worst balance sheet companies in their entirety and then just go berserk on them. You have to have a strategy. You have to do portfolio allocation, and you got to manage your risk. But I'm not debt averse. I don't avoid debt. I look at debt and I say, is it manageable? Do they have assets? Can they pay it off? And what price can they pay it off? What is their break-even point? So the conclusion here is now's the time to put in the work for this commodities bull market because we're just starting to get moving. Now's the time to understand valuations. Now is the time to figure out and how to understand market conditions. Watch my videos, binge watch them, learn and apply to the portfolio if you agree with my approach. This commodities bull market will be epic because of the valuations and the market conditions in real estate. When you combine those two, valuations and conditions, I mean, this is going to be bar none, I think, the biggest bull market in commodities that I'll ever see, and probably most anybody, because you're going to have to get below 100-year valuations again somehow, and then mess up the housing market like they did in the mid-2000s. So this is a rare opportunity. It's a rare opportunity to see some of these oil companies that were like literally 1 or 2 or 3% of their highs. I mean, think about that. 1%. There was companies that were $25 some years ago, 2, 3, 4, 5 years ago, and now they're 25 cents, or were 25 cents at least on the bottom. Centennial Development is one that got very low in relationship, and it almost went bankrupt. But if you're gonna want to ride a rocket ship up, you're gonna kind of have to play with the devil, so to speak, to see if you can escape alive. And if you do, those things are typically the 100 baggers. So the way that you want to do it is you have a portfolio strategy. You don't dump all your money into one of them. You spread it out, reduce your risk, and you just need to capture whatever gains that 4, 5, 6, 7 companies can give you. Because if there is a 100 bagger in there, man, you can change an entire portfolio with just $1,000 in it. It turns into $100,000 with a 100 bagger. Now, if it's a 1,000 bagger, man, you got lucky. You got lucky and you found a really good one. But 100 to 1,000 bagger, they exist. You're gonna have to buy at a bottom, and you're gonna have to be brave, and you're gonna have to be smart about portfolio allocation. Because if one does go bankrupt, it doesn't wipe out your entire portfolio. So, thank you for listening. Leave comments, give me a thumbs up, subscribe to the channel if you haven't. Appreciate you guys listening. This is Finding Value.